Hello, and welcome back to another episode of Fun Friday with a special guest here, a partner of ours. We're very lucky to call him that. Luis Frias with Caltex. How are you today?
Doing good. And yourself, Craig?
I'm doing well, thank you. Did I get the pronunciation right?
Yes, sir. Luis
Good,
Frias.
good, awesome. Well, you're coming out of San Antonio naturally, if I'm not mistaken. You live there,
Correct.
you work there, and then obviously we'll get into the name Caltex, maybe discuss on the partnership you have with Ryan there. But before we get into the San Antonio market, maybe talk about that because you're such an expert there. Let's talk about who you are and how you got into real estate and your capital raising story.
Sure thing. So, Luis Frias, based out of San Antonio. Thanks for the intro, Craig. I started off in real estate as a licensed real estate agent here in Texas in 2015 with Keller Williams Realty. Did that for about 15 to 17 when I made the switch to Keller Williams or KW Commercial, focusing on multifamily. So, was doing residential for a good amount of time, and I did a couple of tours with my team lead on a medical space, and I just immediately they just walk in, they ask, "Hey, Anna, what's the square footage? What's the triple nets? All right, let's sign the LOI." And since then, I just said, you know what? I'm not going to deal with emotion anymore with residential. I'm moving all to the numbers in commercial, and that was my first foot in the door. And after I started doing commercial for some time, I started reviewing OMs and just seeing what I guess niche would have been asset class that I want to focus on. My director had told me, look, you need to go out in the market, interview a couple brokers, get their offering memorandums, and just become familiar with the assets. Because trying to be a jack of all trades, you're going to do one, nobody's going to want to work with you. Two, you're going to be doing wrong by your client. So better to pick a specialization and stick to it and specialize in it. So coming from from the single family background, I remember getting an offering memorandum out of Georgia. It was 230 units. And I was like, man, I'm busting tail just to sell 10, 20 homes a year. And these brokers are selling, one property, and that's 230 units right there and then. So that's where I focus myself. I just said that's where the transaction are, the scale number of units, and the demand is. So after 17, that's when I began just focusing exclusively on multifamily. Brokered a couple of deals here in Texas, Oklahoma, and Kansas. And after about some time, I was making some good commission. I just wanted to be on the other side of the table, not necessarily just doing brokering, but actually investing and becoming an owner operator in these deals. So just as you asked, what's the name behind Caltex? I got with one of my partners or investors out of California, Ryan Catcham. And since I already had an established book of business here in Texas with a good amount of investors, he has the same out in California. It just made sense to bring the investor networks together, and hence the name Caltex, which is he's in California, I'm in Texas. And that's essentially how we got started. So just quickly realized that brokering wasn't enough for us. So, I wanted the ownership and shifted from just helping others acquiring assets to investing myself and then bringing in friends and family through the syndication vehicle.
Yeah, that makes sense. And, very similar story to myself. In some respects, different in others, but, I was selling homes as well prior to getting into the commercial kind of space, the ownership side of it, really, if you will. You obviously went from homes to multifamily, from multifamily to, the principal side. And I kind of quickly realized that, hey, if I want to go where I want to go, I want to get to the investor side of things. And
Yeah,
there's nothing wrong with brokerage sales. It's a grind. Everything you can do is going to be a grind. So just pick the grind that you want to be a part of. And I just wanted to get in a
correct.
car that would take me to the ownership side and get the equity side as quickly as possible. So that's kind of where I ended up here as well. So it kind of makes sense there. And then with that said, obviously, you've done some deals as a sponsor. You've done some deals as, a capital provider, co-GP. Where are the areas you look for from your personal side of things, you and Ryan on the Caltech side? Where are your assets there? Where are you guys looking? So on and so forth.
Yeah, so our buy box is going to be the Texas Triangle, where we're focusing on my backyard, San Antonio. So our very first acquisition was just south of San Antonio on the 35 corridor in Divine. That was a 41 unit. But coming back to it, San Antonio, 35 corridor going to Austin, Texas, Dallas, Fort Worth, Houston. Currently, as we're partnered with you guys in the Houston three pack, that's where our majority of the portfolio is in Houston. And looking to replicate the same success that we've had in the Divine property, operations have been phenomenal. Not only just doing the distributions, but going in excess of the pref payments. So our investors are extremely happy with that property, and just seeing the success that we've had. self-managing, just as yourself. You guys are, vertically integrated completely with property management and asset management. We just see the benefits of having a little bit more control on the steering wheel, if you could say. So that's what we're looking to replicate here in the San Antonio market. Of course, you guys bring us solid opportunities with Lone Star, so we're eagerly, ready to partner when the right deal comes across our desk that checks the boxes.
Yes, let's talk about things that you raise for. So you only do multifamily as your niche from an investment perspective, capital raising perspective, and ownership side of things?
That's correct. That's our primary, our main investment offering that we do put out to our investor network. We are in the process of launching private money lending, so we are going to be kicking out some other opportunities for those that are just, wanting shorter term loans that are focused more on the cash on cash play versus appreciation. We do have quite a bit of investors that are wanting, to be a little bit more liquid than 3 to 5 year hold. They do see the value in it, but it just doesn't fit their needs. So we're going to go ahead and meet that need in providing them with private money lending opportunities and of course the multifamily offerings. But yeah, we have been taking a closer look into other asset classes. I'm doing my own studying and just brushing up on the subjects of triple nets. It seems like a pretty good avenue that we could potentially pursue. But right now, I would say our main focus is multifamily. That's what we started out with, and going to continue to write that. And we see that the fundamentals are strong there, and especially with the construction pipeline tapering down a bit, we should see the new supply being absorbed, and that should reflect back on occupancy ticking back up, which would be favorable for operators. And since there would be a demand crunch with occupancy going up, that's when we should see rent growth coming back into the swing of things. So, definitely still bullish on the multifamily. There's great opportunity. Sure, the market is not ideal at the financing side and operations, but if the numbers work and you're able to get the deal to pencil, why not? So we still remain optimistic on the multifamily front and just looking to diversify outside of that asset class as well.
Yeah, it makes sense to add a little bit of a wrinkle, particularly too, because some deals right now, whether it be doing a big lift in the multifamily space, which some deals, maybe be with operational issues there, with the deal just not working out, you might get deals below that 85%, big occupancy threshold, which means you might have to take on a unique, basically lending structure. And if you have to do that,
Mm-hmm.
well, until that deal is to a certain level, or the debt structure of it might say, hey, you know what? There's no cash flow in this deal, and it's all kind of up-ended, back-ended equity getting paid out. Well, investors might like that, but they also probably want to have a cash flow offering as well. So making
Correct.
sure you do have a cash flow kind of vehicle there is obviously something that investors do care about significantly, of course. So let's talk about, when you are going through the process of looking at deals, when you are sifting through opportunities, what are you looking for when you're making an investment? Like, what are some of the metrics? What are the dynamics that you need to see to get comfortable?
Sure thing. So one, strong market fundamentals, population, job growth. We want to see that the median income in the area, one, is able to meet our pro forma rent. So we're not necessarily wanting to say we're going to be top of market. We want to be affordable with the median income area that, our pro forma rents, that they do support that income. So one, we want to make sure that we're not pricing residents out, that we're able to meet that affordability need right now. Another opportunity is going to be increasing cash flow. So that's not only going to be from rental income, just renovating and increasing rents. There's also ways that you could add value to the residents that they're going to be paying a fee, such as valet trash, bulk Wi-Fi. What other ones will there be? Tech packages. So also, adding extra value, making sure that their standard of living is a little bit higher. Offering those services do come at a fee, which the residents, they're happy to pay it just because it does make their life a little bit more enjoyable. So with those type of opportunities, we see it's a good win-win. So coming back to it, we're wanting to see good fundamentals in the market, the immediate area of the property, that it's a good location. There's a lot of strong employers in the area. We're not looking for one city that's just tied to one specific industry. We want to make sure there's diversity. That way, if there is anything in a market shift or as far as with employers, we could weather that we're insulated for that. So those are the type of opportunities that we're going to be looking in is, strong location. Obviously, we're going to want to get it at a good basis. That way we're already creating a buffer within the market and finding opportunities that outside of rent growth that we're able to go, multiple prong approach to grow rent through other income or even streamlining expenses at some points.
Yeah, that makes a
Places.
lot. Yeah, that makes a lot of sense. And then with regard to kind of the markets in Texas, that's something you obviously have such an expertise on, seeing as that you live in the San Antonio area. So I'd love
Sure.
for you to kind of mention, or just kind of we can go through some of the markets, and then you kind of give what you're seeing on the acquisition side and kind of fundamental side from deals that you've raised for, from brokering opportunities, things of that nature. So just for people to get an educational background on that, what is going on in Austin, just for starters?
So the Austin market's pretty unique. I would love to be in the Austin market. I'm a big UT fan, Longhorn fan. So I have a lot of ties to that market itself, but just the oversupply. A lot of people, during COVID, they wanted to meet affordability. They wanted to get out of, highly dense population areas, so like gateway markets. They saw Austin as a good fit, a little bit of a meet in the middle between, Texas lifestyle and still kind of the hustle and bustle. So a lot of people went there. It drove up occupancy. There was tight vacancy across the market. Double-digit rent growth were, operators were enjoying that for some time, but developers caught wind of it. They're like, well, we want a little bit of a piece of the pie, so let's start building there. And that's what we did see, in the Austin market. I mean, of course, throughout the nation, a lot of overdevelopment. So because of that, there was a lot of new supply. It started competing with, relatively new Class A, and then also started dipping into the Class B performance and C and so forth. But we really saw a hit, in the assets that we like to go for. So, because there was so much supply, and it was essentially shifting the market from a landlord market to a tenant market where they have more pick and choosing, it just drove down rent growth. Landlords started having to put more concessions out just to make people come into the door. So that's what stifled growth. That's what gave Austin kind of the pain points that it's currently having with just the oversupply. But as mentioned, permits are starting to cool down a bit that are being pulled. So hopefully, and I'm still staying optimistic that with the pipeline slowing down, population in Texas is still hot. It's just been kind of hard to absorb all that new supply. But as it starts to be absorbed, we should start to see Austin get corrected and benefit from all these major tech employers that are also moving into the immediate area. So, population growth is still going there. Employer base is still very strong. So I'm still very optimistic on the Austin market itself.
Yeah, that makes sense. And I mean, I think Austin is obviously kind of one of the poster childs of oversupply.
Oh
And it's
yes,
kind of interesting. They talk about, people are like, oh, well, Texas has got all these units coming online. It's like, well, the concentration of those is the conversation. And also, let's call it what it is. Texas is a massive market. It's the size of many states all in one state, right?
correct.
So, you could almost even consider those massive MSAs as one state, as in like, let's call it the Dallas MSA, the Houston MSA, and then obviously San Antonio and Austin collectively as one. Those are almost, from a population perspective, four states in and of itself.
Oh
And it's
yeah.
obviously not all equally distributed, because you've got a lot of suburban areas that've got very little supply, relatively speaking, to more of the urban areas, right? Anytime you buy downtown Houston, they're competing with new supply constantly, rezoning, affordable projects, so on and so forth. That's just going to make your rents very, very difficult and, hard to kind of work on. So we have the Austin conversation. How long do you think it's going to take, though, for that market there, though, to work out?
I think that this year is going to be, I'm not going to say the year of correction. I think it's going to be another two. But, with all the supply that was being completed, it's going to be tapering off this year, and then, Q1, 2 of next year. That's when I do think that the correction should happen as far as, rent growth, occupancy, and all those trends. I think that's when operators are going to start to feel the benefit. The trends be more in their favor as opposed. So I say another full year, possibly this time next year, we should start seeing Austin start ticking back up.
Makes sense. Now let's get into Dallas. What is going on in Dallas, would you say?
A little bit of both. A similar bag, to be honest, with all the Texas metros, there was a lot of overdevelopment. But Dallas does have a little bit of a stronger case than Austin does. Obviously, the population is a lot larger. It has a lot. It leads pretty much for Texas, where all the Fortune 500s are. So it's a diverse employer base. So just overall, the fundamentals are a lot stronger than the Austin market, just similar as it would pair with the Houston market. Huge populations that are able to support a lot of the new construction, like you touched on. Yeah, it's a high number of the amount of supply that we had to hit the Texas market, but given our size of the Texas Triangle, I mean, we're able to meet that need. Yeah, it's going to take us a little bit of time, but it's not going to be something that's completely detrimental to the entire multifamily industry as a whole. So I mean, just everything is cyclical in that aspect. So I think just as Austin is going to have its heyday again, I definitely think Dallas is in a little bit better position. So with that said, we're already starting to see occupancy tick a bit back up in its favor. It's definitely stronger out of the San Antonio and Austin markets, but rent growth is already starting to tick up. So operators in Dallas are benefiting a little bit more, obviously, than the Austin guys. But Dallas overall is a strong market. I continue to see that it's going to be high demand, especially for owners currently in the market today. There's going to be a strong exit for them. There's going to be a vast buyer pool that still see Dallas-Fort Worth as a strong market to invest in, just based off of all the points that I touched on earlier. So Dallas is in a good position, and then next coming up would be the Houston market that I would say
Right.
That's knocking on its door.
Yeah, Louis, so let's go to Houston now. Let's speak on that market. Obviously, we've done some deals there together, which is super cool. That's the biggest market that we're in, and it's kind of funny. Although Houston, compared to the first two markets mentioned, which is Austin and Dallas, Houston doesn't get as much love, but I think that will change here coming up. Jay Parsons, if you're not listening to and following his content, please do so. He's awesome. Actually stated that Houston's one of the top markets for not much supply coming online for big major MSAs. So what is your take on the Houston MSA and kind of that vicinity there?
Yeah, just huge demand, population migration as well. That's feeding into that need. The submarkets that we're currently invested in with you guys in the Houston areas. It's a very good pocket that we're in. I would say just because all the drivers from the employers that we're nearby. For instance, the Meritage is right next to the Texas Medical Center. So, I mean, it has a great amount of demand feeding into it, as well as all the supporting industries that go in hand with medical. But it's just the diverse background. A lot of people would say, and that's where I think the assumption is as well, Houston's an energy market. If the energy market is doing bad in the years past, yes, it has reflected on the overall industry and the overall Houston market itself. But I do see that similar to how Dallas is diversified in its employers, I see that Houston also is going to be taking that. It's trending in that direction. So, with that said, I mean, it's just a strong player in the national markets of who's getting attention, what's up and coming. It's going to be one of those markets similar to San Antonio. It's not exciting that Austin used to get the double digits, same as DFW. But it's stable, it's consistent, and I think that's what investors can do. Is that sure? It's not getting the press headlines that it did before, but just as San Antonio, it's consistent. It's consistent growth that you can count on. That's working in our favor, and I think that's why we do like the Houston market. It's just the fundamentals that it does have: strong market, huge population, and just the employment there as well.
Makes sense. Yeah, I mean, we love Houston. It's, has had a historical reputation, and for good reason, being, an oil and gas kind of one industry market, but with, that area being a lot more diversified, with good schools in the area, with Rice, University of Houston, with the medical areas, with the petrochemical business, with oil and gas there. There's a lot to like there. It's not, the old market that it used to be. Places change over time. There's chip manufacturing places coming into all over to Texas. Houston's going to be in receipt of some of that as well. So lots to love there. And there's historically been we can develop anything anywhere in Texas. Well, yes, it's true. But Houston, funny enough, has got, for such a massive market, has less than 1% of supply coming online of units, as opposed to Dallas, which is getting more supply in select areas. Austin has got 15% of supply coming online. But that's the perfect segue, which is to San Antonio. So I'd be curious to know your take on this. What I'm understanding is that fundamentals for right now are very, very tricky there. Occupancy throughout the market is kind of tough. Obviously, it's deal per deal, how you manage it, of course. But I've heard that it's kind of tough right now in the San Antonio market. Can you confirm or deny that?
I could confirm that. Yeah.
Yeah.
It's all going to be based on how you're managing the asset itself to customer service. That's one thing that we do strive for, especially in the Divine property. It's in San Antonio's backyard. People would say it's a tertiary, but given its proximity to downtown San Antonio, we have a lot of our tenant base does work in the San Antonio area, and then they just live in Divine because they do want to have that affordability, and then two, it's a little bit safer than the areas that they would be able to rent that's close by to their work. But I mean, it all comes down to the oversupply. There was just a lot of construction throughout the Texas market, nationally as well. San Antonio did have a good amount of supply come online too, and given that there's not a ton of rent growth like the Austin or the Dallas or the Houston markets, as I touched on earlier, it's almost kind of I wouldn't say stagnant, but it's not explosive. It's it moves very slow, and because of all that oversupply, a lot of these new developers were trying to get in and take some of the upside that we did see during COVID. And because of that, it switched it from being the landlord market to a tenant market. And because of that, a lot of properties that had, let's just say, good paying residents that were in solid Class B properties, now that they saw all this new supply, a lot of concessions came online, or that they started offering a lot of concessions. People were comparing apples to apples, and they said, well, this one's a little bit pricier, but look at it's a brand new apartment complex. Look at the level of renovations we're getting, the concessions we're getting. So there was a lot of competition going back from new construction to a little bit older renovated assets, and I think that's what was hurting a lot of operators here in the market. Plus, also too, a lot of people during the run up between when debt was really cheap were financing pretty aggressively, over leveraging. Also, their assumptions were a little bit aggressive. So for what I've been telling people, it's been the perfect storm for the past couple of years. You had rising interest rates, operating costs from insurance, to payroll been skyrocketing taxes too, and then of course you have the interest rate environment's just not making it favorable. So putting all those things together along with the new supply, I mean, it kicked a lot of people in the gut. And if you were on top of your asset management and making sure your property was managing well, you did feel a little bit of a dip in performance. We did with our property in Divine. We were able to perform atop of the San Antonio average occupancy. So historically with the Divine property, we're at 93, 95% during their entire hold. But it's just leading with customer service, because although, yes, we're providing housing, at the end of the day, if your residents feel valued, taken care of, they're going to make sure, one, they're paying on time, two, they're going to renew, so your retention goes up. That means your marketing is also going down, and concessions, because you're not having such high turnover, you're not having an offer as much. So you can be even a little bit more selective of who you're bringing in. So that's kind of the way that we've led, is making sure that we're, as you guys have said it before, to lead with kind of a white glove service, is that we want to make sure we're catering our tenants and our residents from the time that they sign up the lease agreement. Any question that they have with the leasing office, they can get a hold of us. Even down to maintenance, we might not be able to fix it that day because the technician might be a day or two out of the queue, but we're going to be there that same day and making sure that it's getting addressed. And if, for instance, an AC goes out, we're bringing you a portable one that we could at least hook up to your window unit. So not a lot of operators do that, but we've seen that going for those extra steps has paid off, and making sure that our residents remain happy, our collections remain happy, and our investors remain happy.
Yeah, makes sense. And I think it's a really important one, particularly right now. Distinguishing factors is when you do have a tenant, making sure you take care of them. And, I think you hit on something so crucial there, which is, not having to turn over units, not having to do a make ready, but retaining a tenant is way more valuable than, getting a new tenant in there, getting a rent bump, arguably. So
Absolutely.
having that there be the case, it's super crucial. It's needed. And it's, how you have good management and keep your costs, relatively efficient. So, even right now, like you might be able to argue that, okay, even if you can get a little bit of a rent bump of $50, you probably have to rather keep the tenant at the same price there before. So,
Correct.
it's things like that I think people often don't think about, but is super crucial on the margins there to make the property profitable and whatnot. So switching gears, Let's go to, how you vet someone that you work with if they're going to be a sponsor, because obviously you guys kind of play in both pools of lead operator, and then also, capital provider in some instances. How do you get comfortable with the group, and, what are you typically looking for when you do want to work with a third party sponsor?
So great question. So at the end of the day, what are we working with? We're working with investor capital. We're working with retirement funds, and just savings, life savings. So we're wanting to make sure that if we do partner with another outfit, one, we understand Caltex's approach, but we do need to make sure that we're not just partnering with anybody to get a deal done, but making sure that we're growing in the right direction and making sure that the partnerships, that we're creating, that they favor the investors. They protect our investor capital. So exactly what do we look for? We network with the different operator sponsors, and then also referral based. So our existing investors may introduce us to a potential co-GP or lead sponsor. We reach out, and then from there, we're just making sure that we're one, establishing a good relationship. Do we get on with each other personally? Can we hold a conversation? It's not awkward. Can we be friends first before we start making that discussion later on about being business partners? Because when push comes to shove, and it does come to shove here in what we do, we want to make sure that there's an alignment of one, morals, approach, and then just management style. So of course we're going to look at the track record. How many deals have you successfully executed on? You guys are very experienced in it. You guys have a very well, solid running, operating portfolio. So that kind of leads to the next one is communication. We want to make sure that they're fully transparent, that they're not only doing just quarterly reports, monthly reports, and then just status updates. If there's a major update that we're getting it. I know when we had the previous hurricanes, you guys were right on top of it with the 3 properties, issuing out just an update to the investors, letting them know what you guys are currently working to repair, what steps have you guys laid out to address these these damages. So that's one thing that we want to make sure that its communication is strong, because we want to make sure that you guys aren't only communicating when stuff is going well, which is easy, but when stuff does make you take a step back and say, how are we going to assess this? We want to make sure that you're communicating that there's also something that we're working through, an obstacle that's being addressed right now. Okay, so the next one is going to be financial alignment. We also want to make sure that the lead GP is also investing in their deal. It does show confidence in it. We do understand that we're investing in a lot of deals too. So are we going to be able to have capital to deploy on every single deal? Realistically, no. But we want to make sure that there's at least some skin in the game, just to give us that a little bit extra assurance that yes, not only do they believe that there's returns are there, or that they could potentially capture these returns, but they're actually putting a little bit of skin in the game to get those returns too. So not only benefiting as a GP on that aspect, but also as an LP.
Makes sense. Yeah. Well, thank you so much for those lessons there, and for kind of your operating mental process there. Let's switch gears a little bit to, obviously it's no secret that the cycle is changing. We're not white hot anymore. Debt's at a point where it's, obviously changed evaluations, pricing. What are some of the lessons that you've learned of late, would you say, over the last maybe 6 months to a year, or 2 years, even if you want to go there, some of the lessons that you've learned in the change of the cycle?
Sure. Being conservative with your underwriting. When we started out in 2019 with Caltex, we didn't close on our first property till January of 2022. So what was going on between that time? That was the high point. People were buying properties and transacting and growing their portfolios, crazy numbers. We stuck to our gut, and listened to it and said something wasn't right. There might have been a buying frenzy. People were underwriting. When I would talk to some of my other colleagues, well, how are you guys getting, not only hitting what they're asking or getting close to what they're asking, but going 10 or 20% over guidance and still able to make your returns pencil? And they're like, oh, well, for instance, I don't mean to say the Austin market, but this is an example. Austin's double digits right now. It's been like that for the past couple of quarters. We see that it's going to continue in that way. So let's continue to invest. And, a lot of our not our investors, but a lot of our colleagues in the space, they started investing and, purchasing and growing their portfolio really well. And right now they're feeling it. They're not able to meet debt obligations. They're having to give the keys back to the bank. They're not able to issue a
Maturities come up.
Exactly. Yeah. And then, it made sense to finance back in the day when debt was cheap. And now that they're looking to refi, they're not able to meet those obligations. So, while other people right now, we were kind of, I wouldn't say on the sideline, we were still in the market underwriting, placing offers. We just weren't connecting on pricing. We stuck to our gut, and now we see that, yeah, we did kind of, thankfully we didn't purchase at the wrong time and overly aggressive pencil just to get deals done. So it just kind of reemphasizes it's just stick to the fundamentals, be conservative, and listen to your gut. Because if at the same time, yeah, we were looking at the market reports and everything, even the CoStar was projecting, solid, favorable rent growth, for the foreseeable future. But just listen to your intuition, making sure that at the end of the day, you are a custodian of investor capital, and you want to make sure you're doing right to your investors. So, that's just kind of made us, double down on our belief that we're not out there for quantity, we're out there for the quality. So we want to make sure that we proceed in acquiring deals the right way, that we're growing, sure, not at a very fast pace, and it's not a sprint. And especially with what we're doing, it's a marathon. So we want to make sure that we're going to be in it for the long game. So growing correctly and growing with the right assets, and of course with the right partners. So to answer your question, the market is completely night and day different. For instance, I got off the phone with a broker earlier this week here in San Antonio. He's like, "Hey, did you check out my email?" I'm like, "Yep, I have it I have it saved. I still have to pull it up and review it." I go, "The reason I saved it was because it said foreclosure sale here in San Antonio. That's a first." So, and he's like, "No, there's about 20 foreclosures last year." And I was like, alarming. But before, like I mentioned, people would be going hard earnest money, day one, non-refundable, over guidance. And it was just insane how the market was then compared to now, that we're seeing bank-owned properties hitting the market now. So, is it ideal? Is the market, a favorable market in the investor outlook? Things look a little hairy. But if you're in the position right now in the market to capitalize when those distressed listings or those distressed properties do hit the market, and you're able to get it at a good basis, well, you're setting yourself up for pretty good investment when the market does correct and occupancy comes back up and rent growth trends in the right direction. You're buying at a good basis. You're still using conservative underwriting. You're financing at today's fixed rates. So when rates start to be dropped or rent growth starts to take off, your debt service payments even going to be less of an issue. And at that point, if it makes sense to refi, then at that you're making a good cash on cash. You have principal pay down, higher rent growth, and potentially you could get your investor equity out just because of the market's appreciation.
Yeah, I think we're in a very unique time, and thank you so much for all that incredible information. So many good points and lessons there. I can't imagine what it feels like to probably be the bridesmaid a couple of times, come close on deals, but not feel comfortable. And then to see all that happen, but then to be on the right side of history, if you will, probably feels very gratifying. So congratulations to you and kudos to you for scaling slow, because I often say and think that sometimes the best deal you do is the one you don't buy. And to deal with that nightmare is kind of demoralizing. It's stressful. You're oftentimes, if something's not going well, you're working 10 times harder to not get paid for anything, just to kind of stay, bailing out water out of the boat there, if you will. So stay disciplined is super crucial. So thank you for that insight there. With regard to, kind of investor feedback, what have you been hearing recently about what they're looking for? Are they kind of looking for cash flow? I have to imagine that would be my first thought if you're kind of introducing a debt fund as an offering perspective, right? Because let's just call it what it is for all those reasons mentioned. And this kind of show the kind of theme of it is, hey, stuff just hasn't really been making as much sense as we'd all like it to do, right? Without our opportunity to do tax exemption deals, we would have bought maybe 3 or 4 deals over the last, call it 2 years, as opposed to, acquiring about, 3 or 400 million or so in the last couple of years due to that vehicle. So.
Yeah. And you guys found a way to adapt. There's a lot of people that are going to be, that's my type of environment to be buying in, but the ones that are staying in the market and are able to adapt are the ones that are making, some solid moves. So I think you guys are doing it a great approach in it by doing that, and especially partnering with, the Houston Housing Authority. You guys are also meeting a need of affordability. So I think you guys are checking a couple boxes off where it's a win-win investment for the community and then also for our investors too. So touching on what you asked,
Yeah,
what are investors?
I had a question and then I had a long-winded statement after. So, what is your
No
investor
worries.
feedback been like recently?
Yeah, so a lot of the conversations is a lot of investors are focused on what can we secure going in. Yes, pref payment's good, appreciation's great, but what's the cash on cash? We get the preferred rate of return, it's great. If we miss it, it accrues. But what are we getting for our dollar? If we put in $1, how much are we getting back out of it? So a lot of investors are wanting to find deals that just based off of how the asset's performing, that it's going to give at least a decent cash on cash. They're more realistic that, we can't be hitting 8-9% cash on cash, or even getting close to 7 now. Depending on how you structure the deal, of course, you could get close to 7. But, conservatively, we're putting out, or the deals that we're seeing that we would like to offer on and do offer on is that an average cash on cash of, low to mid 6. Of course, we're going to be offering, the prep payment to catch them up when we go to do a capital event. But essentially, investors are wanting to focus on the front end. Appreciation is still good, but just because of we don't have a crystal ball, and right now the market it doesn't look too favorable down the road for people that are not in the day-to-day of real estate investing. They really think the forward look is going to be how it's going to be moving forward, but it's cyclical, it's going to change. So a lot of our investors are pushing for cash on cash, shorter term. That way, if there is a market shift, they're able to liquidate, get out, and then get into something that's a little bit more attractive for them. So meeting that need, that's where we found, partnering with another outfit that's their bread and butter, just like Caltex, Lone Star's Multifamily, they do private money lending. So we just felt a good mutual partnership, and that's something that we're getting ready to launch to our investors here in the coming weeks. So we're really excited on that. But it's just meeting the need for our investors, making sure that if they're wanting shorter term, that they're focusing on the cash flow. That yes, we are focusing on that and adjusting our buy box and the way we're underwriting deals for multifamily. But at the same time, if the opportunity is there and a solid partner that we could partner with to bring these opportunities to our investor is there, we want to make sure that we're able to cater to those investors.
Makes sense. What advice do you have for investors right now in the marketplace? This will be the last question to ask. So what advice do you have for anyone new or anyone who's kind of maybe been beaten up a touch, or just for the general person in the marketplace who's looking to place dollars in syndications?
So networking for sure. I even tell our investors, go network with a couple other sponsors. Well, what are you doing, Luis? You're telling your guys to go talk to the competition. That's perfectly fine with us. Network with as many other sponsors as you can. We're not all cut from the same cloth. Everyone's going to have partnership structures differently, profit splits differently, different alignments, different personalities mentioned. Not just doing business, but making sure you could be a friend with them. That's important to me. So just making sure, one, do you get along with the potential partner? Do you get along with your sponsor, your GP? If so, then that's already one box you could check. Next is going to be educating yourself. Not just trusting what's on the deck, trusting on just what's on their PPM or, their projections, actually getting the underwriting and scrutinizing it, doing a little bit of research, because at the end of the day, the lure of syndication is that you're an investor as an LP and it's passive. Well, the only homework or due diligence that you have to do up front as active is going to be just vetting the sponsor, vetting the deal, making sure you're doing your due diligence to protect your own investment. Because yes, all day long we want to make sure we're protecting our investor capital, but at the same time, I want our investors to make informed decisions. So going out, getting educated, reading a couple courses. There's a ton of free courses online on YouTube. You could even go to Barnes and Nobles and pick up some stuff that would give you a good introduction to syndication as itself, because syndication could be applied to different asset classes. It's not just multifamily. So one, just network out there, get educated, and then just start looking at the trends of how the market's performing. Because the last thing you want to do is, you like the sponsor, the deal checks out, but the market doesn't. So just making sure you do a holistic due diligence approach to the sponsor, the deal, and the market itself.
Excellent. Luis, thank you so much for being such an incredible guest, sharing your insights as a local to the Texas and San Antonio area. Where can people find you if they want to reach out more, network with you, connect, learn about your projects that you're doing, and pick your brain with regard to all things San Antonio and Texas?
Sure thing. Appreciate that. Yeah, you can find me on LinkedIn. I post daily. I try to make myself as available. So not only just answering comments and questions that come in through my posts, but you could also send me a direct message. If you want to just have a one-on-one, send me it. I'll send you my scheduling link and we can coordinate there. If you want to get a little bit more information, of course, caltexcapitalgroup.com. You'd be able to go on there, find more information about myself, our business plan, the portfolio, some resources, articles like our resource center. And we also have a new ebook that we just kicked off not too long ago. So if you're interested in high level, a couple, no more than 15 pages, but if you're interested in just getting started in syndication, just knowing what the A through Z is, feel free to reach out. I'm more than happy to speak with you and just make the introduction on that type of opportunity.
Awesome. Well, thank you so much for being on the show today. For all those who have listened today, thank you so much. We will see you next week.
Appreciate it. Thanks, Craig.